Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into topics and issues that we have been discussing here at Quilter Cheviot. I'm Andrew Cartwright, investment manager based out of our Birmingham office, and this week I'm delighted to be joined by regular commentator and head of fixed interest Richard Carter and Amisha Chohan, head of the Quilter Cheviot AIM Portfolio Service. Welcome, Richard and Amisha. So in a week that saw a fascinating season for the English Premier League draw to a close, and congratulations to Manchester City for winning their fourth league title in a row, financial markets remain buoyant as we continue to patiently wait for signs that the interest rate cycle in various parts of the world will finally start to turn. So Richard, you and Jack Bishop mainly focused on the UK economy in last week's podcast and the prospects of an interest rate potentially as early as June. So since then, there have been a couple of reports published on the UK labour market regarding wage inflation and unemployment. And with energy prices falling, UK inflation is expected to drop to 2.1% for April, down sharply from 3.6% in March, and in touching distance of the Bank of England's 2% target. So, Richard, the latest economic data and forecast certainly seem supportive of rate cuts in the UK. But perhaps the most important news from last week was the US inflation data figures, which saw inflation fall to 3.4%, and after some resistance in recent months. So what are your thoughts on the significance and implications of those reports, and in particular that US inflation report?
Yeah, Andrew, I think it was very encouraging actually because for a while now, as you mentioned, we've had sort of inflation coming down in the UK a little bit and coming down in Europe, and that's been raising hopes for rate cuts from the Bank of England and the ECB. But the US inflation data has been quite sticky. And obviously, with the Fed being such an important global bank, global central bank, that's not been great news. And the sort of chances of rate cuts in the US keep getting pushed back further and further, and that's been pushing up bond yields. So the fact that the inflation numbers last week were a little bit better than expected is a relief. We also had quite weak retail sales numbers out in the US as well last week. So I think markets increasingly confident that the Fed will at some point this year be in a position to start cutting rates, and that's got to be good news. Although I think clearly, as far as the running order goes, it will be kind of probably the ECB and the Bank of England starting off their cuts first, and then the Fed later, probably in the autumn.
So just turning to other parts of the world, and you mentioned there that the ECB certainly look like they're going to start cutting rates, and that looks to be sort of fairly imminent. But also sort of news from last week, Japanese bond prices fell, and that was in anticipation that the central bank there could actually increase interest rates. And we saw in China, where the stock market really has sort of languished when others have been performing very well, that they announced a package to help stimulate the alien property sector. And just over the course of the weekend, we heard that the Iranian president has died in a helicopter accident. So, Richard, there's been quite a lot going on elsewhere in the world. Did anything there in particular catch your attention as being particularly noteworthy, or give you cause for concern or optimism?
Yeah, I think the Iranian one is interesting. I mean, when obviously the president's died in a helicopter crash, you say, and some talk, will this lead to a sort of change in policy or anything like that? I don't think so. It seems like the regime is fairly well in place at the moment, and the sort of policy in terms of friendship with Russia, anti-Israel kind of policy is going to be maintained. The person who really calls all the shots in Iran is not actually the president; it's the supreme leader, the Ayatollah Khamenei, and the person who died in a helicopter crash was seen as a possible successor to him. So they're clearly going to be looking around for sort of an alternative now. But I don't think overall policy is going to change. So the sort of fragile Middle Eastern situation probably carries on. Likewise, China property, that's been rumbling on for some time, weakness in the property market. Now and again, the government comes out with a sort of new package to try and prop up the market a little bit. And there's usually sort of initial pop up and pop up in markets, and then analysts come out and say it's not going to be enough. This was exactly the same as that. There was a bit of a sort of rally on Friday, but actually people looking at it and saying it's too small to make a difference. There's clearly a huge stock unsold new homes in China, weighing down prices overall. And that was this sort of stimulus package was aimed at that. But as I say, I don't think it's going to make a difference. So, interesting things going on. But I think it's probably this week back to focus on central banks, focus on inflation, and clearly for us here in the UK inflation numbers on Wednesday are going to be very, very important.
So as you mentioned, interest rates and inflation still very much at the forefront, and they've very much dominated the financial headlines for the past few years, and markets have ebbed and flowed as investor expectations have changed. And we saw a rally in many of those interest rate sensitive investments, which have struggled so much over the past few years towards the end of 2023, but they have since drifted back as market expectations around the timing and extent of interest rate cuts has been pushed back. And there are, of course, many assets and instruments that have an obvious direct relationship with interest rates, including mortgage rates, bonds, and cash yields, but there are also other areas where the correlation is less transparent. And in January, we heard from one of our research analysts, Matt Inyons, talk about the impact on the infrastructure investment trusts, which are primarily viewed as long duration assets and use discount rates as evaluation methods. And last week, Samir Shah talked about the negative sentiment towards smaller and mid-cap companies, notably in the UK and the US. And that has persisted through the interest rate environment that we have experienced over the past few years. So following on from last week's discussion, I'm very pleased to welcome back Amisha Chohan, who's our lead manager of the Quilter Cheviot AIM Portfolios service, to have a closer look at what's been happening within the alternative AIM market in recent times. And smaller companies, including AIM stocks, by their very nature, tend to be viewed as higher risk and more vulnerable to economic downturns and macroeconomic shocks. And looking back in recent history, they experienced a sharp sell-off following the Brexit vote, and then again with COVID. And having performed very strongly in the post-COVID recovery period, sentiment again turned negative as we moved into that high inflation, high interest rate environment. Although, as Samir mentioned, we have seen a notable pickup in takeover activity this year. So, Amisha, firstly, could you tell us what has been happening in the AIM market over the past year or so, and perhaps touching upon the macroeconomic environment, the relationship between interest rates and smaller companies? And secondly, we had that bit of a false dawn towards the end of 2023 with the expectation that rates would be cut sooner and quicker than has proved the case. But it is clear that financial markets are anticipating we are at the top of that rate cycle, and it's just a case of when rather than if it will turn. What are your thoughts also on the outlook for the AIM portfolio as and when that cycle does eventually turn? And have you made any changes in how the portfolio is positioned to reflect that?
Some great questions there, and lots of questions there. So let me answer them one by one. So you're right, the AIM market, which is the smaller, the junior market to the London Stock Exchange, has struggled over the past couple of years, really on the back of one key word, which you've talked about, which is inflation. And that had driven that hiking of the interest rate cycle. And what we see with small cap companies is that they are typically growth companies. So the way that you value a growth company is by looking at the discount rate. It's by looking at the interest rate. And that impacts the way that you value a business. And given that interest rates had been hiked up so much, the value of those companies therefore fell. And actually, what you would see is the reversal of that. So when interest rates start to fall, you'd start to see the value of those companies naturally improve. So a number of things that you've asked there. The first has been, what has the past year been like? And actually, what we've seen over the past 12 months is every time there's some talk around interest rate cuts, or actually when in Q4 we saw interest rates, when the Bank of England had talked about interest rates finally achieving peak, you saw a massive rally, and that is what you would typically expect, and that has continued into parts of Q1, definitely in January and February. In March it kind of reversed back, and then we've seen that momentum continue in April and even May today. And so our view generally is that small mid-cap companies within the UK are depressed. The valuations are very low when you compare them to history. And if you believe that interest rates are going to fall this year, then small mid-cap companies is where you want to be positioned. Firstly, because you'll see re-ratings coming through. And secondly, we believe that the earnings downgrade cycle has almost stabilized now. So the probability is that you will typically see earnings stabilizing, stroke even growing over the course of the next 18 months. And those are the two key drivers behind why one should be invested in small mid-cap companies within this cycle. And if the market doesn't acknowledge it, then we think there'll be plenty of other people interested within this space. And we've seen that through private equity bidding for companies in terms of stocks that we actually own. So even this morning, we've seen a bid come through from a private equity company on a company that we own, which is called Keyword Studios. And the premium from Friday's close is actually 73% higher. So that is a huge disconnect. And I suppose that disconnect relates to the fact that this company has had a depressed valuation for a number of reasons, and private equity can really see through that and take that longer term view.
So the Quilter Cheviot AIM portfolio service is first and foremost a specialist investment portfolio for those clients looking to shelter part of their estate from inheritance tax. Tax rules can, of course, change, and we've notably seen the capital gains tax allowance reduce over successive years. And with an election in the UK due by January 2025 at the latest, taxation usually features as a pretty significant part of the political parties' election campaigns. So, Amisha, could you remind us of how, under the current tax rules, qualifying AIM stocks and a Quilter AIM portfolio service can potentially help clients mitigate inheritance tax? And with that UK election coming up, have any of the major parties indicated, at least at this stage, whether they're likely to implement a meaningful change to the inheritance tax regime, and if that will form part of their election manifesto?
Of course. So the Quilter Cheviot AIM strategy benefits from potentially saving your clients' loved ones with 40% inheritance tax. So the way that works is that if you invest in our strategy, where we have stocks that qualify for business relief AIM stocks, if you hold that for 2 years or more, and if you were to pass away after that period, your loved ones would save up to 40% inheritance tax. So that's the key benefit around the Quilter Cheviot AIM strategy. And you're completely right about the political landscape. I mean, the key question is who's going to win the election. And all the polls out there are saying that it's going to be Labour. So if we assume that Labour is going to win the election, they have not said anything around kind of IHT and abolishing it, which actually the Conservative Party have talked about. And therefore, we think that if Labour were to win, the impact that it would have on the IHT strategy would be limited. They may make some tweaks around kind of tweaks, but we don't expect it to be anything substantial. And then the question would be that if Conservatives did win, and if they were looking to abolish IHT, I think the actual ability to do that is very difficult. It's great having an idea that you can just throw into a newspaper and gauge whether someone likes it or not, or whether you're likely to win an election on the back of it. But the actual implementation of it would be extremely challenging, just given the fact that it's all written into law. And then we've seen how Brexit's been really difficult to kind of decipher and come out of things. I think it'll be the same with this. And so actually, we're not concerned about any changes in political landscape at all impacting IHT going forward. And therefore, we think now's a great opportunity, if you have an IHT issue, to invest in a portfolio where valuations are depressed. Earnings should be stabilizing straight growing over the next 12 to 18 months, and you've still got that IHT benefit there.
Amisha, Richard, thank you very much for your insights today. And just before we draw to a close, I'm delighted to say that the Quilter Cheviot's Markets Uncut podcast has been shortlisted for an Investment Marketing and Innovation Award, with the winners to be announced during the ceremony on Wednesday, 3rd of July. So congratulations to Richard and all those involved. And if any of the listeners have any questions that they would like to ask Richard or one of our analysts for a future podcast, you can put your questions forward to our team of experts by submitting them via the weekly comments page on our website. We'd love to hear from you. So to stay up to date with our thoughts on markets and current issues, please visit our website at www.quiltercheviot.com. Here you can also see more of what we're doing here at Quilter Cheviot, as well as what's past webinars on demand, and subscribe to our weekly comment newsletter. We'll be back again next week. And in the meantime, for those of you on social media, you'll be able to see up-to-date content on our Facebook, Instagram, Twitter, and LinkedIn pages. Thanks again to Richard and Amisha for their time today, and to you all for listening.